Hi, and welcome to Accounting Capital. Today we're going to be covering 50 finance metrics that every finance professional must know. We have divided this into 5 parts, and first coming up is accounting. Okay, so accounts receivable turnover. It says net credit sales divided by average accounts receivable. This shows how quickly a company collects outstanding debts from customer. Accounts payable turnover. Total supplier purchases divided by average accounts payable. How quickly a company pays its supplier. Working capital ratio, current assets divided by current liabilities. Company's ability to meet its short-term financial obligation. Debt to equity ratio. Total debt divided by total equity. Proportion of company's finance that comes from debt versus equity. Gross profit margin. Revenue minus cost of goods sold divided by revenue. This shows the percentage of revenue that is left over after deducting the cost of goods sold. Net profit margin. Net income divided by revenue, showing percentage of revenue that is left over after deducting all expenses including taxes. Return on asset ROA. Net income divided by total assets, how efficiently a company uses its assets to generate profits. Return on equity ROE. Net income divided by total equity, showing how much profit a company generates with money shareholders has invested. Inventory turnover. Cost of goods sold divided by average inventory, showing number of times inventory is sold and replaced during a period. Fixed asset turnover. Revenue divided by fixed assets, how effectively a company uses its fixed assets to generate sales. Coming up questions, because we have completed 10 financial metrics in accounting. A company's working capital ratio has declined from 1.8x to 1.1x over 2 years. What could be driving this change, and what action would you recommend management take to improve short-term liquidity? The decline suggests that the company's short-term liquidity buffer is shrinking. Possible driver includes faster growing in current liabilities than current assets, slower customer collection, high inventory levels, increased short-term borrowings, or weaker cash generation. To improve liquidity, management should focus on accelerating receivables collections, optimizing inventory levels, renegotiating supplier payment terms, reducing unnecessary short-term debt reliance, and improving operating cash flow through tighter cost control. If temporary refinancing short-term liabilities into long-term debts may also help. Next is cash. Under cash, we're going to be seeing 10 more financial metrics. Number 1 is coming cash burn rate. Cash spent monthly average, cash received monthly average. This shows the net cash spent by a company in a specific time frame, usually monthly or normalized to a year. Next is average day delinquent ADD. Day sales outstanding DSO minus best possible day sales outstanding. Measures effectiveness of collecting efforts, often used at client level to compare with others. Operating cash flow. Net income plus non-cash expenses minus increase in working capital, money generated by daily operations. Free cash flows, OCF that we have just read, plus interest payments minus asset purchases. This expands on OCF concept by also including interest payments and including asset purchases. Next is overdues ratio. Overdues divided by total receivables measures your effectiveness of collecting cash and the quality of your receivables. Days of inventory outstanding DIO, average inventory divided by yearly cost of goods sold into 365 days. To just explain you in a better way, these 365 days are multiplied by the division of average inventory divided by yearly cost of goods sold. This shows the average number of days that a company holds inventory for before turning it into sales. DSO, day sales outstanding, average account receivables divided by annual sales, whole multiplied by 365 days. Average number of days that it takes a company to collect payment from a sale. Day payable outstanding, DPO, average account payables divided by average cost of sales, whole multiplied by 365 days. This shows average number of days that it takes a company to pay its supplier. Cash conversion cycle CCC, DIO plus DSO minus DPO, day to convert inventory into cash flows from sale. Cash reserves in days. Cash reserve divided by average daily expenses measures how long your organization could survive if cash dried up tomorrow. Question coming up is, A company revenue is growing but cash flow is weakening. What could be causing this and what should management focus on? This may be caused by slow customer collections, higher DSO, excess inventory build-up, higher DIO, faster supply payment, low DPO, or rising operating cost. As a result, growth is consuming cash instead of generating it. Management should focus on improving collecting, optimizing inventory, extending supply items where possible, and strengthening operating cash flow conversion. Next category is CEO. What financial metrics does a CEO should see? And we have 10 under it. First one coming is revenue growth. Current period revenue minus previous period revenue divided by previous period revenue measures the increase in revenue from one period to another. Gross profit margin, revenue minus cost of goods sold divided by revenue. This measures the percentage of revenue that remains after accounting for the cost of goods sold. Net profit margin, net income divided by revenue into 100 measures the percentage of revenue that remains after accounting for all expenses. Return on investment ROI, gains from investment minus cost of investment divided by cost of investment, and this shows the measure the return on investment for particular project or investment. Earning per share EPS is net income divided by preferred dividends divided by average outstanding shares. This measures the amount of net income attributed to each outstanding shares of common stock. Customer acquisition cost CAC, total marketing and sales cost divided by number of new customers acquired. This measures the cost of acquiring new customers. Customer lifetime value, this is average annual revenue per customer into average customer lifespan. Customer acquisition cost, this measures the total value of customer brings to a company over their lifetime. Employee engagement is employee engagement score based on the average response of an employee survey. Measures the level of employee satisfaction and commitment to the company. Employee turnover is number of employees who left during the period divided by average number of employees during the period into 100 measures the rate at which employees are leaving the company. Next coming up is your question, and the question says the company revenue is growing strongly but the net profit margin, cash flow and employee engagement are declining. What could this indicate and what should a CEO prioritize? This may indicate the growth is being achieved inefficiently through higher cost, operating strains, or weak internal culture. The company may be scaling sales faster than profitability and employee capacity. The CEO should prioritize improving operating efficiency, protecting margins, strengthening cash generation, and addressing employee morale and retention to ensure growth remains sustainable. Next category is SaaS, and we have 10 financial metric under this. Customer churn rate. This is customer lost divided by total customer, percentage of customer lost in a given time frame. New buyer growth rate, that is new buyer this month divided by new buyer last month divided by new buyer last month. This is the speed at which you gain new customer over a defined period of time. Lifetime value is customer value into average customer lifespan, revenue from customer over the retention time period. Customer acquisition cost, cost of sales and marketing divided by number of new customer acquired, amount of money a company spent to get a new customer. New burn ratio, that is net burn rate, cash spent minus cash received. Net cash spent by a company in a specific time frame, usually monthly or normalized to a year. Runway, current cash balance divided by burn rate, time that a startup has before they run out of finances. Average revenue per user, this is total revenue divided by total number of customers. This shows the average revenue generated per customer either monthly or annually. SaaS quick ratio, this is new MRR plus expansion MRR divided by churned MRR plus contraction MRR. This shows the compares revenue added new business versus revenue lost. Next one is monthly recurring revenue. It is number of customers into average billed amount, that says monthly revenue from customer with a subscription. Total addressable market TAM. It is annual contract value per client into number of potential clients. This shows the market size of a product service in value that the company can achieve. Question time. So, a SaaS company is growing customers rapidly, but churn is rising. CAC is increasing and runway is shortening. What could this indicate and what should management prioritize? This may indicate inefficient growth where new customers are being acquired at a high cost but not retained long enough to create value. As a result, cash burn increases while revenue quality weakens. Management should prioritize improving product retention, reducing churn, optimizing acquisition spend, increasing customer lifetime value, and extending runway through strong unit economics. Now we're gonna be doing 10 key financial metrics for investors. First one coming up is return on investment, ROI. It is income from asset divided by asset investment. This shows how much money you made compared to your investment. Return on equity, ROE, net income divided by shareholders' equity. It measures the return on shareholders' equity. Earning per share, EPS, easy one. Net income, average number of outstanding shares. This shows company profitability on per share basis. Next coming up is price to earning ratio, that is PE ratio, one you must have heard about it. This shows market price per share divided by earning per share, meaning price of a company's shares relative to its earnings. Dividend yield, annual dividend per share divided by market price per share, showcasing return on investment from dividends. Net promoter score, NPS, percentage of promoters minus percentage of detractors. This measures customer satisfaction and loyalty. Debt to equity ratio, simple one. Total liabilities divided by shareholders' equity measures the company's financial leverage. Current ratio, current assets divided by current liabilities, company's ability to pay its current liabilities with current assets. Quick ratio, current asset minus inventories divided by current liabilities. Company's ability to pay its current liabilities with quick assets. Gross margin ratio. This shows revenue minus cost of goods sold divided by revenue. Showcasing measures the profitability of a company's product or services. Question time, the last one. A company's revenue is growing but ROE is declining. Debt to equity is rising and the PE ratio remains high. What could this indicate and what should an investor assess? This may indicate that growth is being supported by higher leverage while returns to shareholder are weakening. A high PE ratio suggests that market still expects strong future performance, which may not be justified if fundamentals deteriorate. An investor should assess earning quality, debt sustainability, cash generation, management execution, and whether valuation expectations remain realistic. Thank you very much to listening to me till the end, and I'm going to be publishing part 2 which have 50 more financial key metrics, but it depends on how well this video goes. So please comment down and make sure this video does very well.